We're also going to be watching what's going on with bank stocks tomorrow. Let me call those up real quick. Those are still in the green, but a lot of big banks are going to be reporting their numbers. The impact of rising rates and elevated inflation going to be in particular focus as we watch the banks here tomorrow. So let's get a preview on what to expect when it comes to the bank. Well, let's bring in Gerard Cassidy of RBC. Gerard, it is great to see you here. So give us sort of a big picture look, first of all, as to what we should expect from the banks. It feels like generally for earnings, expectations are pretty low, although I don't know if that's true for the banks in particular.
Well, Julie, I think what you're going to see with the banks reporting their numbers tomorrow are very good numbers. As you pointed out, rising interest rates have been so positive for the net interest margins for the banking industry. We've been covering the industry for a very long time. And I have to tell you, I don't ever recall seeing banks report net interest revenue growth year over year, anywhere between 20 and 30%, which is what we're going to see tomorrow. So it's been a very strong top line revenue growth for the companies. Now, the real question is, as the economy slows in 2023, what will the credit losses do? And of course, they're likely to go higher. The question is how much higher, and how much money do the banks have to put aside tomorrow for these expected credit losses? But we think this revenue growth is going to more than compensate for the higher credit losses. So we expect to hear that tomorrow the revenue is good. Loan growth was strong in the fourth quarter. Credit's going to be strong. And I think the real question is, what will these management teams say about the outlook for 2023?
Gerard, I want to hone in on JPMorgan. I think it's been out on an island somewhat over the past few months. And by that I mean we see Goldman laying people off. We see BlackRock laying people off, just given the slowdown in M&A and other investment, other parts of the business. Is it time for JPMorgan to be more aggressive on cost cuts, then also pull back on some of this tech spending they've been very aggressive on in the past few quarters?
Brian, it's a really good question, because of all the stocks, JPMorgan has been the stock that has been questioned about their expense growth. It's been higher than its peers. And I would say that on the tech side, there really will not be any cutbacks for JPMorgan or any of the other banks, because tech spending is so critical. Now, there may be an ability to maybe resize the workforce. Obviously, you pointed out about Goldman Sachs. They had a sizable downsizing of their workforce this week. But Morgan's been hesitant to do that. They see more opportunities in the investment banking area, even though we all know that was a very difficult period in 2022 for JPMorgan and its peers in investment banking. So I think what we'll see is that they'll look to slow the growth expense down, but I'd be surprised if there's any big significant cuts coming out of JPMorgan coming from either tech spending or downsizing their workforce.
I do wonder if they're going to pull back on small acquisitions, Gerard. And admittedly, I know this is a minor story, but it is such a fascinating one coming out in the past 24 hours. First, the Wall Street Journal saying that JPMorgan is alleging that a company it purchased is accusing it of fraud, effectively. A college financial aid platform called Frank. It bought it for $175 million. Now CNBC is saying that it's shutting it down because it said the founder made up 4 million accounts. I mean, I'm just curious what you make of that story and the company's oversight and diligence in making this kind of acquisition.
It's interesting because, when you buy these digital companies or these online companies, it's quite a bit different than buying a traditional bank. And obviously JPMorgan, as well as its peers, they've built their franchises with the consolidation of traditional brick and mortar banks. So there's a higher degree or greater degree of risk in this internet space, if you will, when it comes to financial services companies. Obviously, this is a terrible situation for them, even though, as you point out, relative to the size, it's a manageable number they can handle. But it does have to question, they have to go back and relook at what went wrong with the due diligence and how to fix it so this doesn't, happen again in the future. But they are, under Diamond's leadership, he's been incredible for shareholders since he's been at JPMorgan. They are looking to become very tech savvy, and they do it both through organic growth as well as acquisitions. And unfortunately, this was a step in the wrong direction.
Gerard, who has not necessarily been keeping pace with some of the others in the industry, and that's Goldman Sachs. I mentioned the layoffs here, but that stock now really trading at a pretty noticeable relative discount to the likes of their competitors. How much pressure, when you talk to investors, how much pressure is David Solomon underwrite here to start executing better, and what else should they be doing?
It's interesting with Goldman Sachs. It's a premier, we all know it's a premier investment bank, but the investment banking business is cyclical. And as much as how difficult it is today for them and their peers, we have to remember 2020 and 2021 were absolutely gangbuster years for Goldman Sachs and the industry. And now we're in, obviously, the downswing in investment banking was far more severe than any of us expected, but it's eventually going to come back. The world needs to access the capital markets. We're just in a downswing. And unfortunately for Goldman, they are, that's their primary business. Now, where there's been a misstep, of course, under Solomon's leadership, has been the expansion into consumer banking. And that, I think, is where the criticism is appropriate because they haven't executed there. But in terms of the actual investment banking, wealth management, trading or markets, Goldman's doing a very good job. It's unfortunate, though, the market conditions really are what's driving, in my opinion, the lower valuation. But if we look at Goldman, Brian, over many years, 5, 10, 20 years, and you look at the value they've created for their shareholders, it's been very positive. They're in the top quartile of the top 20 banks, even though on a valuation basis today, they do trade at a discount to their peers.
Gerard, put it all together for us, if you would, and just briefly, what's your favorite bank stock going into this earnings season, and what's the one you're avoiding?
Well, Julie, I would say that when you look at the banks in the big picture, it's really interesting today because, as you pointed out in the opening remarks about higher interest rates, that the right side of the balance sheet for the commercial banks is critical. Now, for 15 years, we didn't have to worry about that because if the Fed kept Fed funds rates at 0 to 25 basis points, the value of those cheap consumer core deposits was very low. But if the Fed is going to 5 or 5.5% on Fed funds, and you as a bank have a bucket load of cheap core consumer deposits, you're going to have a real advantage. And I think that's going to show up again in this quarter. So the regional banks, names like Fifth Third, KeyCorp, PNC, M&T, I think are the names to play. Those are the ones to watch because they have those cheap core deposits. And then I think on the investment banking side, we got to be very careful. So to avoid the names like Goldman that we just talked about or Morgan Stanley.
Gerard Cassidy, RBC Capital Markets, head of U.S. Equity, Bank Equity Strategy, and Large Cap Bank Analyst. Always good to see you. Enjoy the start of earnings season tomorrow. I'll talk to you soon.